From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for January 10th, 2025. Checking the calendar, the NFL playoffs begin this weekend, and your Green Bay Packers are the underdogs in Philadelphia on Sunday. Your Milwaukee Bucks are in Florida and New York for the weekend, and then 4 home games this coming week. And let's not forget the Admirals. They're home tonight with Texas. This is a weird start to a strange week. If we didn't have enough reason not to go to North Korea, how about this? Kim Jong-un now bans hot dogs and Spam. He says cooking them is an act of treason. If he would just meet little Oscar, I'm sure they could work things out. Plogging is a new event started in Sweden in 2016. It's picking up litter while you're jogging. It's a good way to get in shape and clean up your city for the 3 people that are going to do it. This one puts a smile on my face, and I'm not even a video gamer. Gamers are accusing Elon Musk of cheating at popular video games by allegedly hiring better players to play for him. I guess he can afford it. And from AccuWeather, Florida, we have our first falling iguana alert of the season. When the temperature falls below mid-40s, the lizards start falling out of trees in semi-conscious states. Well, at least you don't have to shovel them. But you could. On the podcast, we have Art Rothschild, Tom Pappenfus, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Plenty of reasons not to visit North Korea or Florida in that, so appreciate the insights as always. A note to our listeners, just ahead of our recording today, you have Gruber Law Offices moving into the 411 building on the 19th floor just below us. You may hear some pounding. That is perfectly normal, perfectly typical part of our day. So apologize in advance for any extra noise you might hear in this recording. Overall, a rough week for the markets. The NASDAQ down 2.3% this week, the first full week of the year, although still not technically a full week with Thursday market holiday for National Day of Mourning. The S&P 500 down 1.9% on this 4-day week. And the Dow Jones Industrial Average also down 1.9%, down 794 points this week, closing at the bell at 41,938. For the year, the NASDAQ down 0.8%, the S&P 0.9%, and the Dow Jones Industrial Average 10 days in down 1.4%. That's a quick look at the week, Art. I think it's hard not to start this week with maybe a bit of a look at what was some good news, at least I thought good news on the labor front, and yet it seems we remain in this pattern as we have, it feels like for some time, of good news being bad news.
Yeah, I'm going to leave the details, I know you are as well, to Joel, who will fill in the finer points. Oh, sorry, dude. It's up to you on those numbers. But yeah, very, very good week from my perspective, I think. I mean, it's kind of mixed message with respect to employment. I mean, unemployment went down a little bit. That's good. People are finding jobs, although maybe not as much as at one point or another. And from my perspective, it looks like it's a pretty solid economy. Continues to be. Last week, without this information, the stock market went up. This week, as you indicated, the first technically full trading week of the year, the market went down. So I think they're taking good news badly. And why they're taking it that way is because the good news on the labor front suggests that the Federal Reserve doesn't have to lower interest rates. And the market wants lower interest rates, which kind of begs the question, which would you rather have, a strong economy or a weak economy? And I think from the Fed's perspective, they'd rather have a strong economy, and they're doing the right things methodically to keep it that way. So I thought it was a great week. Unfortunately, stocks went down because some investors just react badly to good news. And it's a pattern, as you indicated, that happens periodically. And we have to get through it because over time, stocks go higher when the economy expands, when profits go up, when people are spending money. And I expect that to continue now, potentially for the rest of the year, absent something to change the course of the economy.
Yeah, I think maybe investors are expecting too much right now, right? That we have the strong economy that has more or less been the hallmark of the last few years. But we also get those low interest rates that kind of help stock prices move higher, that give us less of a discount on our expectations for future earnings. And I think the reality is you're asking a lot if you think you're going to get all those things at the same time. It's about earnings and interest rates. The strong economy helps the earnings piece. A weak economy tends to help the interest rate piece, but you shoot yourself in the foot long term because who cares that you don't have to discount future growth as much if there is no future growth. And so I think I'd much rather, and this is the point I think you're making, Art, is I'd much rather have the strong economy because it means long term I've got much better prospects for what I'm looking at.
Well, I think in fairness, if I may provide a counterpoint kind of along the lines of what Kyle was saying, is just, I mean, markets being a forward-looking mechanism, and bear in mind the thing we always have to marry in what we do and talking to clients is short-term versus long-term outlook, right? So the markets, traders, markets move because they can make money in short periods of time. And so if you have a model, right, a financial model, and you're, like you said, Kyle, you're discounting based on interest rates, and if interest rates are higher, obviously, analysts are recalculating their models, and it's coming out with a lower price, fair price for a stock. So naturally, traders are going to react, and probably leading up to this moment, prices have been priced, have been counting on lower rates for a longer time, and a much different outcome than what we're starting to see. So, I would say that, I think they're doing the right thing. It's not, I guess, unreasonable to me as much as it does sound crazy to say, hey, good growth and now bad prices, but I guess it's just a function of the math and the models.
Which brings up, and I totally agree with you, but it brings up a point of the fact that different people are doing different things every day. So every time there's a buyer, there's a seller. And every time someone's applying a model that is disappointed because the Fed won't be lowering interest rates as much, there are other people applying models to say, oh, but growth may be higher, going forward, or higher sooner than was anticipated. Not to mention the backdrop of it's a new year. You've got people prognosticating on a regular basis with respect to what's going to happen at any point in time, but even more so during the course of the year. And, layer on top of that this new administration coming in. And with the Fed this week, providing the minutes of their last meeting in which they lowered rates, they did talk about, apparently among themselves, that we don't know what's going to happen in the coming year. There could be policies that could result in higher inflation, so they're justifiably slowing the rate at which they're reducing, and we know the direction at this point seems to be reducing interest rates, not raising interest rates. So as a long-term investor, absent, again, some force going the other way, I'm still thrilled, right in here. And I had people calling to buy stuff today, which never happens, but it did today.
No, I agree. It's a good thing, right? I mean,
good prices. Yeah. Joel, maybe we were talking around the headline a bit here. What we're really getting at is the fact that the labor data we saw this week, and in particular the non-farm payroll number on Friday, was a little bit better than what we thought it was going to be. It maybe has given some investors some pause about just how far they think the Federal Reserve is going to go to cut rates. It certainly pushed the 10-year interest rate higher this week. But, what can you tell us about kind of what we saw?
Well, employers added jobs in the U.S. for the 48th month in a row, which was, pretty spectacular. And they did it at a rate that was greater than the monthly average for this year, so they added 256,000 jobs in December, which is above the average for 2024, which also is below the average for 2023 and below the average even more so for 2022. So the hiring is still going. It's slowing down, though. And then the unemployment rate was 4.1%, which in most times would be considered full employment.
Yeah, and I think you look at expectations as much as we look at some of this historical data, right? And really it is historical data at this point. It's not what's happening now. It's what already did happen. And you get to the point where you start to look at, all right, what are expectations for hiring? How do people feel about their prospects going forward? Showing some signs of improvement there, which might be influencing some of that conversation on rates in the Fed. But at the same time, we have other pieces of data that maybe are a little more mixed, things like the consumer credit number, which, to my eye, that it looks great, right? That we had this decline in outstanding credit. But when you think through maybe some of the reasons why, it isn't quite as clear of a story.
Sure, yeah. In November, the Fed reported that consumer credit debt went down at a 12.1% annual rate. That's a lot. That's the most since the pandemic. However, the month before that, it went up at a 13.4% annual rate. So there's an offset there. And again, just cautioning listeners that you don't put a lot in 1 month's numbers. It's important to look from 1 month to the next and to see the patterns that are developing. But you're right, Kyle. If consumers are starting to restrict how much they're using their credit cards, it suggests that they're not as confident spending. And if that happens, that's doesn't bode well for the economy, because 2/3 of the economy is based on consumer spending.
Or it could be that they're being more prudent and disciplined in their spending. We don't really know. And so if you look at why the stock market collapsed as the economy was collapsing in 2008, is because people were using their houses, as credit cards and borrowing too much and running up too much debt. And we're not even, I think, relatively speaking, up to where we were then in terms of debt. So I think it's a very good thing that people aren't running up as much debt to spend, because we know they're still spending.
Right. Per person, yeah. I mean, that's true, that the household debt burden isn't as great as it was back then. But
Thank you.
But we're still having record numbers of record amounts of credit card debt.
Yeah, and I think, there is this second piece, which is that there's a good portion of our population now in retirement that maybe doesn't need the credit cards as much anymore. And I think the more you have a retirement portfolio that's your source of income, the more you have Social Security, pensions for those lucky enough to still have them, I think the less that credit card spending and carrying those balances is a piece that's going to be part of our economy. And so I think that might shift a little bit. Yeah, it's not going to matter month to month, but longer term, it might shift a little bit how we view some of those revolving debt numbers, because quite honestly, there's going to be a smaller portion of our population that relies on that as its primary source of maybe carrying the month-to-month spend.
And Kyle, before we get too far away from the employment report, I wanted to just add the other hand is that, I'm spotting in here some longer-term sorts of trends that say that, although the hiring environment seems to be pretty robust right now, there are chinks in that we've seen some things like, the unemployment rate itself is 4.1%. It's been between 4.1 and 4.2% for 7 months in a row. So there may be some stagnancy there. I indicated that the number of jobs added is lowering from year to year, but you kind of expect that. But there are some other things. The one number I always look at is the hiring of temporary help, which suggests that employers are hiring workers to try them out, to see if those workers fit, but also to see if they need those workers to keep the business going. And those numbers keep going down month after month after month. We had numbers this week on jobless. On job postings, on openings by employers. And within those is a number on the number of employees who are quitting their jobs. And that's a good sign for the economy, because if the quit number is high, that means that workers are feeling confident that they can get another better job, and those numbers keep going down. So there are some things to sort of watch there to say that not everything is rosy.
But are those good or bad? And I know you've been interpreting this on a regular basis as being, it isn't the way it used to be. And that's because I don't think the labor market is the way it used to be. Employers are hiring more people and holding them so they don't need as much temporary help. And maybe people are more satisfied with their jobs, and there's been articles on this as well, post-pandemic, because they got out of jobs that maybe were in declining industries or whatever. And furthermore, this number, which you mentioned before, 256,000 jobs. In the old days, when we had an economic cycle in which we would have a recession, you'd see the hires go down into the hundreds, 150 to 50 to nothing, to you're losing jobs. And we aren't seeing that. So this is a very...
That for 48 months.
Yeah, this is crazy.
Yeah, right.
This is crazy good, and that's why the stock market went up over 25% each of the past 2 years. And that's why, as you've also informed us, corporate profits are projected to go higher this year and next year. I've never seen numbers this good consistently.
And as far as employment changing, I mean, I don't think anybody can deny that. And one of the other numbers that I was looking at was the percentage of unemployed people looking for jobs who have been unemployed for more than half a year. That number's up.
Well, to be counter to
that's
that,
interesting
those people
because
are not employable, for God's sake. That's why they're unemployed in the first place.
And that may be the case. That may be a bigger proportion of the people who are looking for jobs just don't fit in, and maybe those are people who are more easily replaced by artificial intelligence or other sorts of technologies.
Which I think gets back to your question of Art of is that good news or bad news? And I think the answer is yes, right? That when you look at what did it mean for the last few years, well, it clearly meant that there was plenty more opportunity than we thought. When you look at maybe what it means for this week or this month, yeah, okay, maybe there's a little more uncertainty. And when you look at what some of that change means going forward, I think it points to all the opportunities we've been talking about for a very long time. And Tom, maybe one of the things that came out of that was this conversation on, the Magnificent Seven or the kind of growth stocks versus the value stocks. And you were telling us a little before the podcast about how we've seen some shift recently, maybe in just how concentrated, the market returns have been the last year.
Yeah, I mean, I think it's important at this moment, especially you get longer in the tooth in a bull market, that obviously investors, us included in that group, and as well as everyone else, how do we feel confident? Where are we going to put new monies, new dollars? Art, you said they're calling you to put new money, and you're kind of like, well, where do I go now? Do I buy expensive stocks because I believe expensive stocks will get more expensive, or otherwise? And I think Kyle, as you alluded to, yeah, the numbers on Magnificent Seven. Basically, about 63% of the S&P 500 return in 2023 was responsible to the Mag 7, and just last year was about 55%. So we're seeing a bit of a change in the markets. Markets, especially this artificial intelligence boom, are starting to shift. The whole talk about artificial intelligence and what kind of wave of investing this provides is, in the early stages of this, obviously it's going to be the early adopters, right? The big players that are out there that can afford to buy all the equipment. You ask them directly, they don't know exactly what they're going to do with it, but they're going to buy it to be on top of it when it's here and when it's recognizable. And I think the investors' sentiment is starting to change. Well, okay, now they've adopted it. Who's the next to benefit from it? Is it them, or is it down the production chain? And so I think you're starting to see sentiment shift as far as who may be the benefactors, and again, the ever-present search for greater value. Looking at the numbers between also growth and value. Obviously, we saw that especially in the last month or two of the year, growth really again outperformed value. Big surprise, right? It's the dominant style sector that contains technology. But what's encouraging, if you're looking for a little bit better value, maybe a better value proposition, is that earnings growth in the Russell Value 1000 Value Index is projected about 12% next year, which is the highest it's been in 3 years. So we're starting to see earnings growth decelerate in the Mag 7 companies. It was forecasted at the beginning of 2024, 50% earnings growth, incredible number. Now, when the year was finished, it was about 38% growth. Expected for the next 12 months. So we're seeing the expectations, from the markets decline with that concentrated names. And so now is the time to start to, hold balance and don't chase returns, as we always say, and keep a balanced mindset.
I think that's the most important part we always come back to is the importance of balance. And we don't begin to pretend that we know what's coming tomorrow, but I know that if you stick to the plan, if you have an appropriately balanced portfolio, that you give it a little bit of time, it's going to work out for you. And so I think those are all great points today. As always, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.